No problem. We'll have to get everyone on an accelerated talking schedule here, but lots to cover. I mean, this is the investor perspectives, a very interesting, exciting time. We're covering 2023 and beyond. We're covering the latest trends. There's a couple very topical trends. I don't think we can escape a little bit of discussion around SVB, as well as what's the macro environment that we're in. We have a great group and diverse group of panelists, some that represent the corporate VC side to international institutional style investors to the venture debt providers. Just real quick about us before I introduce panelists. Yes, I'm HoltXchange. We now manage early stage investor. We have about 40 seed stage companies looking for the early ones that we can help carry on to the next stage up to Series A and beyond, matching them with our advisor network, Holt Advisors. In fact, many of the panelists that are on here are in fact Holt Advisors. Our goal is to identify good companies, invest with them, and then co-invest alongside some great investors or help facilitate the deal-making process. We are doing some quite unique things. In fact, we believe in sort of democratizing access to a greater society. So we've done some great investments that enables that, but we've also done it ourselves through the way that we raise capital. We'll be announcing very shortly the ability for every style investor to invest in our own funds, providing access to a pool of capital that many investors wouldn't be able to access. So if you are interested, feel free to ping me. I'd love to talk to you about how we make this happen so that you can invest in a diverse portfolio of global companies serving North America, as well as the underlying tech stack that we're building. But enough about me. I really want to hear what our panelists have to say. So I'm going to actually invite the three of them each get a chance to rocket pitch yourself, much like the founders would have to do, right? So let's hear how you pitch yourselves. But I also want you to give me a quick story or an example, an anecdote of a founder who got your attention in a positive way. I mean, there's always the negative ones. I want to hear the good ones and how they capture your attention so it moved the discussions forward. Who would like to kick it off?
I'm happy to
go for it, James.
Thanks, Sanjay. Hi, everyone. I'm James Povitz. I'm a principal at NA Ventures, National Bank of Canada's corporate venture capital arm. We make strategic investments in companies that can add value for NBC, its employees, and its partners. We've been around for about 6 years, have made over 30 investments. A majority of our investments are in use by NBC or its partners. We primarily invest in fintech at seed and Series A, but not exclusively in those categories. Jan, to your question, one founder I really appreciate is Andrew Graham from Borrowell. Specifically, I think Borrowell nailed the problem identification for both their users and the FIs who distribute products on Borrowell's marketplace. Financial education and credit improvement are key issues for Canadians, and cost-efficient lead generation is critical for FIs in Canada. Borrowell was the first company to offer free credit scores in Canada, and over the years have added products that continue to help inform and improve financial wellness for Canadians. By offering free credit scores, financial knowledge, and recently credit building products, they have really come to understand their user base and then can position them to receive the right products at the right time. And over the years, Canadian FIs have come to rely on Borrowell as a key channel for client acquisition because of the way they've enabled the use of this credit score.
Awesome. Well said. And I think that's a great example of how you can use product to support your marketing initiatives and a lead generation tool, because after it was developed, giving it away free, but it's a way of classifying good, strong leads thereafter to provide them with the right solution at the right time. Maybe Sanjay, because you were fighting for the mic right away, why don't you go next here?
Absolutely. No, and not to say, James, great example as well. We're also big fans of Andrew at Borrowell and glad to be co-investors. There, quick overview on White Star and myself. White Star Capital is a global fund. It's been around for about a decade. We manage about over $1 billion across 6 different funds. Our focus is Series A and Series B investments. So we typically make investments that range from 5 to 30 million in to startups here in North America, in Europe, and in Asia. We've backed about 70 founders so far, and really a third of our fund has been dedicated to fintech investments. Personally, I'm a partner. I lead our Toronto office, been at the firm for a little over 6 years. Previously was in investment banking at Rothschilds in London. And prior to that, I did a documentary film series on entrepreneurship in emerging markets. In terms of stories, I think one founder or one founding team that really caught my eye was the founding team of Flare Systems. This is a cybersecurity company based out of Montreal that focused at its onset on providing data leak prevention and notifying services for FIs in Canada. And I met the team at a founder pitch event back in 2019, a few months after they had started out. And what really caught my attention positively is they had, without a sales team, with just an MVP product, in under a month, managed to get 3 out of the 5 large Canadian banks on board as customers. And that's unheard of and unseen in cybersecurity in terms of metrics, in terms of go-to-market. And that told me that there's something really incredible about their product that we just had to dig in and get to know more. And that led us to come into their seed investment at that point.
Fantastic. That is a great story, and a story of explosive growth, especially getting across that early hurdles, right, as you're crossing the chasm. So very impressive for them to be able to do so quickly and get to those following rounds so quick. Last but not least, Monique, would you like to, let's hear from yourself.
Yeah, sure. I'm president of TIMIA Capital. We're a venture debt provider. So we're based in North America. We provide founder-friendly, non-dilutive debt to B2B software companies. And it can be human-enabled hardware. Now there's a broad definition of tech. We're founder-friendly in that we don't take board seats or warrants or personal guarantees. We try to make it very clean that way. And we focus in the 2 to 10 million kind of ARR level. My background is as a founder, so I'm very empathetic to founders. I worked at Vision Critical. I had my own Fintech startup doing automated underwriting. So as a venture debt lender, it's not about pitching us and all of that. It's very data driven. It's very based on historicals and their forecast. But I'm an angel investor and advisor. I have a very soft spot for the Fintech space. So if I was to talk about a company that's got my eye, it'd be a recent one that I've invested in and have been advising. And it's HoltXchange, and it's led by a woman, Yvette Wu. And she's an ex-Van City person. The other 2 founders that are there are Van City and the credit union space. They're doing something really boring, which is something that I really like. You can fly under the radar, which is creating a marketplace for institutional investors and financial institutions related to, right now it's primarily for GICs. So you're City of Vancouver and you got a bunch of tax money that's sitting there and you want to get the best rate, you can basically sort of put a post-it there and go through that process instead of kind of a manual process. So I really like what Yvette's doing. She's really dynamic. She's out there. She's aggressive. And I think female founders need a little bit of an extra leg up to get into the right doors.
Awesome. Well said there. And certainly very topical sort of type of investment, something that helps you to maximize your returns on cash, which might be an interesting segue, shall we not? Move into, okay, each of you it's been a fun weekend. Hopefully you guys got some rest over it, but certainly you all had different exposure and different experiences over the last week, attributable straight up to the SVB fallout. So maybe you can walk us through a bit what was the last week like for you guys, especially with respect to portfolio support. Do you want to go in reverse order this time, Monique? You can kick it off.
Yeah, sure. Yeah. I mean, if I was to sum it up in a couple of words, it would be lots of communication. So, initially we moved fast to identify who in our portfolio was affected, reached out to them to give them to support, to look at the exposure. Most of them were below the 250K, so they were, feeling good. A couple were above that, feeling a little overexposed. Something that we identified is, some of them, because of the way Silicon Valley banks only had a business operating account with Silicon Valley Bank, and so that created big issues. They were really scrambling. Everyone worried about payroll. We just reached out and offered support. We were trying to share information. I'm sure there was stuff flying all over the whole weekend, trying to share what we learned, most of it right, some of it wrong. But, just trying to, I think we created a lot of goodwill because we were just really there. What do you need? How can we help you? Do you need extra time? Do you need help with payroll? And it looks like everything is kind of working out for the best. And thank God. One company was being acquired to push that deal out because they used the bank, and which is all fine, but a lot of chaos, and really felt for those founders having to ride that roller coaster.
And as a debt venture provider, obviously it's worse to see. I mean, you never want the founders to go up anyways, but you also potentially have a means to support in working capital. So were you able to increase or support, especially on such a short turnaround period?
We offered. So we always provide a facility, and then we have a first disbursement, and then they can have second disbursements. So, usually we do a refresh due diligence with a second disbursement. We just said, like, if you need something, just let us know, and we'll transfer it over. Part of it became like, where do we transfer it? Is where some of them sort of got stuck. So that's big learning moving forward. But yeah, that was easy for us to do, and you know what, psychologically for them, just knowing that they were able to do that really helped. So.
Awesome. Well, maybe we'll shift over, because you talked about the ability to, where would you put the capital, or diversifying bank accounts. James, you went through that a little bit. So you represent a bank in yourself. So what was it from your vantage point?
Similar, like starting with communication and then a lot of analysis on who has exposure to SVB or indirect exposure to SVB, and how does that impact runway. Was kind of the first step at a very detailed level of granularity very, very quickly. So in the course of maybe a day, then it was outreach to the companies with the similar kind of, what can we do for you? What do you need? And, we're open for business. We have bank accounts that you can put your money in if that would be helpful to you. So there was a lot of collaborating with our tech and innovation banking team to just be as useful and as quick as possible, which is always a great opportunity for us to show how we can be there for our clients. There was also a lot of briefing of kind of our executive level, both because they're interested in our portfolio and to just get a general feel of what the venture ecosystem is feeling from this. And kind of now it kind of hasn't ended. It's okay, all the companies that had lines in place with SVB, what can we do with them? How can we help? Do you want to bring them over to national? Is there other introductions we can make? And kind of facilitating that credit decision as a secondary piece to the cash thing. That was really last week problem, and this week is more facility.
Very interesting. So it very much shows it's very advantageous to have a collaborative, diverse cap table, so you can access the benefits of those different parties that are around. Maybe to Sanjay, how were you seeing it from your side?
Yeah, from our perspective, I mean, on the Thursday morning when the 8K filing came out and the letter from SVB came out around the balance sheet troubles, right away it prompted a kind of global email internally to look at our situation across the portfolio and to start to advise portfolio companies to evaluate their cash positions within SVB accounts and pull out that cash. On the Thursday, I happened to be in SF at that time, and had a series of meetings with different funds lined up that we regularly catch up with. And it was quite an interesting and surreal time to see just how quickly the information had traveled from the morning till, across lunch and across the dinners that I had, and how everyone in a just rapid instant acted in a way, in a very rational way on an individual level. But when you look at it as a whole, it was quite a lot of communication. I think a lot of panic, a lot of stress for portfolio companies, for investors, for LPs and funds across the last couple of days. Thankfully, that seems to have come to a resolution since Sunday evening, and we've heard over the last couple of days, checking in with our portfolio companies, that everything is fine now in terms of having access to payroll, having access to funds, and having accounts restored. So a positive ending to what could have been quite a big problem for the whole industry and for the whole economy. But it is interesting. I mean, there's a lot to unpack in what happened over the last 4 or 5 days, and there was a lot of learnings around having multiple bank accounts. We spent the weekend checking with every one of our portfolio companies to ensure that they have multiple bank accounts set up. There was a lot of creative things that were done with using Stripe accounts, using other kind of working capital accounts to move funds on a short notice. But everyone now who doesn't have multiple accounts, I think both on a personal level and on a corporate level, is revisiting all of that and ensuring to have the right safeguards in place.
Yeah, it's a very interesting time as any founder, right? You go from low cash levels to, if all goes well, a massive influx where you're shocked to see the amount of zeros on there, but not fully considering. And then now you have to more consider, okay, I have so much liquid cash flow. I need to get smarter about how I do this. So one bank, multiple banks, how do I measure, and get some form of, put some of it to work, but make sure it's all safe, most importantly, because, got to avoid the downside risk there. Maybe flipping into just longer term. I know we're spending quite a bit of time. So what do we see kind of moving forward, how this might affect the industry as a whole? Or is there other things to consider? I mean, is this going to cause more risk aversion already in a risk averse markets? We've seen some other institutional failures in 2023. This is kind of the year where some things are happening and causing some pause for reflection. So what do we kind of see in a go forward? Not just, I don't want to hyper target just this review, but there is a macro worldwide this occurred as well. So anyone want to kick that off with some thoughts there?
Yeah, I mean, I think it actually creates an opportunity for some of us, with the biggest player sort of out of the market. I mean, it's going to affect people at the lower end who are already struggling. Unfortunately, this is probably going to accelerate things. But even with this sort of squeeze on venture capital that's been out there and low valuations recently, there's like good deals to be had out there. So our thinking is there's going to be even better deals that are there, and some of the other players in the market are going to step forward and fill part of that void. It means that, you do have to be a little bit more proactive about risk management. There's going to be other things that we're looking at, being a little bit more stringent on, on some of the elements. But I think that was happening anyways in the current market. So it's just going to, put the screws on all of that a little bit more.
Any other maybe specific? I remember Sanjay, we talked about this earlier. The idea of due diligence and the change of regulations that could happen. How did you see that?
I definitely think that this is, well, we've already seen in the case of the UK, this has already brought on a change in regulation. When it comes back to the issue of having all your funds tied up to a single bank account, the reason why companies did that and startups did that was not for a lack of kind of poor governance or judgment. In many cases, it was because that was a condition that came along with the venture debt, that all of the funds had to be held in a single account. I think now clearly see why that's an issue. And so the UK has come up with regulation to ban this type of request. Canada as well has got regulations around that, and the US will soon follow in terms of limiting those types of risks. It's also interesting in terms of on the long term, in terms of opportunities that creates on the startup side. We're hearing from a lot of our startups over the last couple of days, well, it's great, we've set up now these accounts, we have accounts in 4 different banks, but at the end of the day, we also need to run a business in an efficient and smooth way. And if we keep having to reconcile accounts across 4 or 5 different bank accounts, that actually adds a layer of operational friction. And that is a prime opportunity for a fintech startup to come as a middle layer between the existing banking infrastructure that's there, and to offer a bit of an aggregation layer for a startup to have that level of protection while operating in a frictionless environment.
Well said, and patent pending, I suppose, from Sanjay there, but brilliant. I think that does certainly create some opportunities.
Any founder with that, I'd love to hear. I'd love to meet.
Absolutely. We're not in the business of billing ourselves, but in financing them accordingly. We like to meet them first, though, because we're earlier than you, and we'll pass them up to you. How's that? But all jokes aside, okay. James, do you want to kind of speak on this too? I mean, Monique pointed to the point of the idea that there's opportunities to invest right now. It's a great time to invest, but is that true from just the macro side? I mean, if sentiment is down, how are you seeing sort of the medium term and longer term, the investor confidence, the ability for teams to invest? Like, what's your sort of take on that, especially when you're on behalf of your portfolio companies?
I think many companies currently in the process of raising funds can face some delays as a result of this. Like, funding has already declined substantially, and shocks like this take like a substantial amount of time and energy away from funds on deals that they're working on. So depending on the size of the fund, that could be like pretty distracting. There's also just like a sentiment of what happens next, of course, that's going to have its impact. And just specifically on the fintechs, like whose ideal client is a small bank in the US, it really changes the like who they're going to be selling to and the speed of that, and their kind of their sales forecasting as a result of this could be pretty large. It's also, I think, just worth noting that like many companies in this climate rely on debt to extend runway. Under like bad market conditions, you might be pulling on that line, and with the line no longer there, and potentially your cash kind of in a frozen spot, companies are going to have to go out to market maybe earlier than they would want to, with less cash in the bank, which will have an impact on investor sentiment and will also have an impact on potential debt providers they're going to see to get new lines, because so much or some of the initial analysis is really like, well, how much cash in the bank do you have today? And that's a different discussion today than it was, 6 months ago.
Yeah, those are great points. Maybe on that note, if we're talking and hanging in the pocket just around the venture debt as a component to fundraising, then maybe we could just talk a little bit first about its evolution. Maybe, Monique, do you want to take the reins on this one and talk about how it's sort of evolved from before to now, and where you think it might go, and how your clients should think about it as an overall piece to their fundraising strategy?
Yeah. And I think it starts out, we're talking like about a broad range of different technology companies here. So the stage that you're at really matters. So, we look at companies that are 2 million in ARR to sort of 10 million and a little bit above. If you're below the 2 million, like first off, you're not going to qualify for venture debt or debt anywhere. You're going to want to be bootstrapped, or you're going to want to find some early angel investors, et cetera. And then, as you're getting bigger, you really have to be careful how much debt you are carrying and what the rates are for all of that. So that's why we kind of have a sweet spot. We've always kind of operated in that 2 to 10 million and up to a certain, facility size. But what we found this year, like our pipeline is super strong, and especially with companies that there's sort of 2 use cases: companies that have managed to bootstrap and want to continue to bootstrap because of where valuations are at. But we're also getting companies that did around, let's say, a couple of years ago or 3 years ago, and now they wanted to raise last year. Valuations aren't good, and they're like, okay, well, I can't do a down round, and I don't want to do, be flat. I've tapped out my existing investors, and so venture debt can be a great way to sort of get you to the next. I know we're going to talk about it later. When is this all going to change? So, how do you get through the next sort of 2 years so that you're in a good position and valuations are stronger? So it's a great opportunity. You have to be careful how much debt you take on. Absolutely. A good venture debt provider is actually going to work with you on that. No one wants to give you too much debt and, make it so that you're not successful. So, we tend to look more at historicals and into the first year of their forecasts, and how is that going to get you where you're going. We don't fund product development. It's all about growth, right? So if we can help them turn on the marketing and the sales engine and take it to that next level, then that's the right application of venture debt for that.
Interesting. We appreciate that context. It certainly aligns with Finance 101. There is an optimal level of debt, but I do want to flip it over to Sanjay, where maybe there's sometimes there's maybe too much debt. I'm trying to get is it a stage thing, or how are you seeing it with your portfolio companies and how you're helping them think about the strategy of venture debt?
Yeah, I think a couple of things with the economic climate that we're in, where we're a lot more risk on at the moment, and there's a lot more just general volatility in the market, and on top of what happened with SVB recently, we covered. I think beyond the question of deposits, the other question that kind of came to our mind is anyone who has taken out a venture debt facility now with SVB at this point, what are the risks in terms of if them calling back this debt because of the extraordinary situation that happens? That's not a risk that in the past was on our list, let's say on our radar, but it is a risk that must be considered now, and so that increases the overall risk level of venture debt because there is that risk of funds needing to be called back. I mean, the biggest difference between equity raising and debt raising is that debt needs to be paid back at a certain point in time or can be called back, versus equity, which cannot. So there is a general sentiment of just having a little bit of cautiousness. Does that mean that companies are not going to raise venture debt anymore? Absolutely not. It is a great instrument to be paired on top of an equity fundraise when the timing is right. But it does mean that companies are going to start thinking a little bit more about what's our redundancy, and depending on the level of debt that they take on, what can we do if suddenly we need to repay that debt and have cushion or room or an alternative funding plan to be able to repay that debt and not put the company in a very difficult position. As we're seeing at the later stage, large debt funding that comes with a lot of different covenants can put a lot of operational pressure and stress on a business. And that's just something to be mindful of.
Very interesting time to just be a little bit more cognizant of your financial modeling, how it affects. I mean, if everyone is eager about profitability, too much venture debt affects that, and not having too many restrictions around it. So more scenario analysis around it to make everyone more comfortable with this situation going forward. James, any last words on venture debt or other sources of financing to complement these financing rounds as we go forward?
Yeah, I think just it's always the best time to raise debt is when you have cash in the bank. So for this reason, we always suggest that our portfolio raise debt as soon as they close a round. They're better off paying standby fees and sitting on credit than they are trying to get it when runway is tight. It also goes without saying that companies should be applying for every possible grant and tax credit available to them. In a world where capital efficiency is more important than ever, we expect and give credit to the founders that make the most of public funds that are available to them. And everyone should remember that they exist.
Great points. I mean, it ties to the whole notion a bank will always lend you an umbrella on a sunny day, right? So, but when it's rainy is when you need the umbrella the most. So you already want to have your umbrella stocked and ready to go. Definitely, I would love to unpack the grant situation. I think it's a conversation in itself, although sometimes it's a little inefficient, right? So you're applying and spending a lot of time for these grants. It can certainly slow you down. Maybe actually I'll just real quick, because you did bring it up. What is sort of efficiency, right? Like, I mean, we see there's a whole whack of these Canadian grants that are out there. You could be doing shreds for those who are aware of it. So you're writing off a big portion of your R&D side of it, although it's really about R&D. So it's really supposed to put towards something that has a probability of failure, right? And it doesn't ensure move fast and fail fast, but it's hard to sometimes build your core product and commercialized product when you have to think about that, or the type of grants and the amount of work that you have to do to create transparency is challenging. So it almost eats up more time versus raising. It's a very low cost of capital, but it's expensive in terms of time. What's your perspective on sure, being efficient, but the expense of almost losing speed?
I think like working with your fund and your backers for them to help you identify the right ones, and also working with some of the publicly available tools that both from the government of Canada and from the provinces. And there are some startups that are, some of them, I'm blanking on the names right now, we're not invested in them, that actually do and offer some of this, like automate some of the grant writing process and are able to kind of streamline and use some of the publicly available searching tools kind of even more efficiently. And those are kind of popping up all over the place. So starting with the Government of Canada website, I know it sounds daunting, but they have a decent tool at least to get started to know what you don't know or get some clarity there, and then ask your investors. They'll point you in the right direction.
Yeah, I mean, it's interesting. Oh, sorry, Monique, we were about to say something.
I was just going to add, I mean, I think, go for it all. Sure, it takes time, but think of the time you spend fundraising. So, there's a pretty high probability that you're going to qualify for all of these things. So the more you do it, the faster you get. There are lots of other companies that can help you to put them in, but I say absolutely go for it, especially in the early stages. It's great connections and networks. You meet other people. There's lots of tips and tricks for it. So
yeah, and the one thing I would recommend, everyone should be looking at Shred. Regardless, I think that's probably the easiest, although that's a tax credit, so you get that after. If you want to front load it, you have IRAP. Those are kind of the big two ones. Provincial gets, and then we're getting more targeted. Depends on your industry, but I want to look at that. All right, I want to talk real quick about fintech valuations and this market conditions. Sanjay, you guys have looked, I'm sure, a lot at this, especially from maybe an international perspective. There's obviously been a drop. Some would argue that relative to other industries, a substantially larger drop. So are we recalibrating back to 2019 levels of trajectory? Because obviously there was a blip. How are you guys seeing this right now?
We're absolutely recalibrating back. We've also definitely seen a much bigger drop in overall multiples in fintech than we have seen across the board in other industries. Just to run through a couple of quick statistics, in fintech at the peak of the market around October 2021, we were trading at around 25 times forward revenue. Today we're below 5 times. So we're really high at the peak in October versus compared to traditional enterprise software where we were at the 15x range at the peak, so not as high, and now we're at around 7 to 8x. So both cases, of course, the markets have corrected from 2021 to going into 2022. But we have seen an overcorrection in fintech, partially because of the high point at which we were in 2021, and partially because rising interest rates have directly impacted the business models of several companies in the industry. When you think about the whole buy now, pay later grouping within fintech, that business models become quite unprofitable, quite difficult to operate in a high interest rate environment from a lot of the large players that were there. Another reason for this has been that a lot of neobanks or firms that were depending on, think of when you look at Revolut, for example, which is the largest neobank today in the world, they're at their revenues, a lot of it has come from trading and a lot of it has come from crypto trading. And so with the drop in just general Robinhood, general retail investor trading activity, as well as the drop of the overall crypto and digital asset trading activity, we've just seen a lot of these business models come under a lot of pressure. And that's why we've seen a disproportional kind of drop in multiples on the fintech side.
Awesome. No, I appreciate those insights there. Maybe focus on specifically the venture debt side of things, Monique. Have you seen a change, an increase in interest rates? How do we see that projected in the future? Specific on covenants, how were they before? What are being looked at on a go-forward basis? Especially, Sanjay pointed out some of the covenants. I mean, he mentioned high level that some might be more restrictive. I don't know if we can get kind of a little more granular there, but how are you seeing it, Monique?
Yeah, I mean, definitely, rates have gone up over the past year. I mean, from us, what it also means is we can get better quality companies. We don't have to take the riskier ones, so that helps us. We always have burn covenants. We work with the company to put those forward. We try not to make them too restrictive, but I've been a founder. You have to be positive and optimistic, and you can see the overly optimistic ones where like, hey, we want them to bat it out of the park too, but you got to make sure you have the levers to control things if sales don't go as you're expecting. So we do work with them. We get monthly metrics and we monitor things closely. So whether that's restrictive, I mean, we're just trying to help them out because we know they are carrying that debt, right? So and we'd like to see that they have a plan and they're going along. I mean, we might do things like maybe alter the facility size that we're putting out there. We do have some that are two-year term deals. We might, most of them are sort of 4-year, but maybe we'll be a little bit more cautious on the 2-year deals just because of that. So it's kind of the same stuff, but maybe a little tightening of screws. But definitely, it's more expensive out there. But it's more expensive everywhere.
Interesting.
It's more expensive it's much more expensive on the venture capital side, what it's costing them because of the valuations.
Gotcha. Yeah, for sure. I got a question from the audience here. Are there specific areas within fintech that the investors believe are more resilient or attractive to investors during this time? And I'll flip it also. Are the ones that are somewhat less resilient? I know, Sanjay, you touched on some of that, but that's open to all. So what are people seeing?
Happy to jump on some of the ones that we find quite attractive at the moment. I think there's 3 areas that we're quite excited about. First one being all around embedded finance. So solutions that allow you to simply use any kind of financial services in a low code, no code way that you can plug and play it into your product, into your website, into your application. We're big fans of that in terms of democratizing access to fintech solutions. We're also big fans of kind of what we call fluid rails, or making it just easier to move funds from one end to the other end. I think it was interesting in Alex Tapscott's presentation just earlier. He showed the picture of how complex today's banking infrastructure is in some ways, and you'd argue that part of the reason why it's that complex is because of the regulations and the safeguards that are in place to prevent something like an SVB to take place. But at the same time, it is also not practical from a business a sense to have too many frictions like that when it comes to moving money from one place to another. So finding solutions like that, I think we talk a lot. We have a digital asset fund that invests in that space, and we also invest in traditional fintech, and we talk a lot about Web 2.5 being at the intersection of finding a solution that kind of fits those two worlds. And the last piece that we're quite excited about is everything that comes to real-time data. And this is especially on the accounting side. I think a lot of, especially in this point in time, every VC, wishes they could have a real-time view on the, and I think every founder as well, on the cash position of the business, on the burn, on where money is going. And I think in the coming years, we're going to move more and more towards this kind of real-time visibility on operational and financial data within an enterprise and within funds.
Awesome. Great insights there. A lot around streamlining and removing frictions, of course, the kind of the core of what it, but maybe I want to flip it to James as also, working at National Bank. There's also a different perspective too. So there's probably things when you guys consider there's a strategic investment component to it, and could the bank adopt it? So beyond just the key ones, maybe some key areas that you also think might be where the venture capital ecosystem, like which areas they might be more willing to partner, these financial institutions partner with fintechs. Do you, just as a whole also, do you think this current situation where a lot of these institutions have been shaken up a little bit, some of them been substantially hurt for their footings within it and their exposure to it, how are we going to see those type of partnerships on a go-forward basis? And is there specific industries or verticals within fintech that are, better suited or more interesting for big financial institutions?
Yeah, I think first, like fintech bank partnerships are going to continue to flourish. So as the perspective of the CVC of a major bank that's been doing this for like 6 years plus, our executives and lines of business are hungrier than ever to work with fintechs to find innovative and cost-efficient ways to solve problems. Fintech partnership from our perspective is no longer just a fringe opportunity for us, but kind of a first level consideration when we're trying to solve some of these problems because of the speed at which they will allow us to solve them. The amount of requests we receive from business lines to work with fintechs like literally increased by the month, and the scope of what we're allowing fintechs to touch within our business continues to expand. It's no longer just about client acquisition and product distribution, which is, I think, was the earliest stage of those partnerships, but now we're seeing opportunities for collaborations, obviously in open banking, in fraud, and even in core servicing functions across product categories. But fraud being a kind of a major one, where there's so much opportunity to leverage technology that banks just don't have right now. And then, of course, with the increasing reliance on these fintechs and the exposure to them going down comes an increase in diligence and the care that we take to choose who we partner with. But it's not disproportionate to the opportunities.
Yeah, and I would add on to that. I've always thought, in fintech, security is a barrier to entry, right? And so there are actually companies out there that are making that easier. And, so I think they're going to do really well. I think any fintech that has not got their security sort of nailed down, they're going to, you just can't work with the banks. You can't sort of get to that level. And it is a big investment. It takes a lot of time and expertise to be able to do that and invest in all of the, the technology that you need for that. And that sort of ties into integrations. I always look for, does this fintech, has it got all the integrations that are needed to sort of be a turnkey? Is it easy to, how long does it take to set this up, and how sticky can you be by having those integrations? So once you're in there, if you're integrated into the, their core banking systems and all of that, the more you can do that, then the stickier it is, because it can be a long sales cycle into these FIs to get in there. But once you're in there, you tend to be pretty secure. So that's what I look at for ones that are going to succeed.
Very interesting. And it's challenging too. If you're building a fintech, you need a substantial amount of capital to be able to take care of these extra business as usual hurdles. So then therefore, if there's the valuations have been decreased and you need more capital, it's definitely a trying time right now. And we'll see how that, but of course, when you unlock, these big financial institutions can be very sticky, as you pointed out, and can generate substantial cash and very quickly grow back in those valuations. So we'll see how it all rebounds here. I have some rapid fire questions, probably just to throw this out to wrap up our panel, because I know we're in 3 minutes time. So for each of you, real quick, Regarding new investments into new companies, will you be increasing, decreasing, or maintaining levels compared to last year and compared to COVID years? Who wants to go first?
Increasing.
Increasing as well.
I would say maintaining or decreasing.
Okay, interesting. Regarding new investments into existing companies, so existing portfolio companies, same story. Will you be increasing, decreasing, or maintaining levels compared to last year and the COVID years?
Increasing. We always have a facility and they can take second disbursements. So we are seeing more of them are doing that.
Yeah, for us, we always keep 50% of the fund in reserves, and that remains the same across the board.
Same with us, maintaining.
Maintaining. All right, so similar there for there. Okay, so we didn't have time to talk about this one, but will AI and maybe Chat GPT that's out there be a game changer, a slight improvement, or no real change to your portfolio companies as a whole?
No change.
I hope so, but I haven't seen it yet.
Yeah, slight improvement. We think there's already a lot of AI integrations, and we're not necessarily thinking that there'll be a giant leap because of this.
Right on. How important is sustainability and social responsibility in your investment decision-making process? High, medium, not really present?
Unfortunately, not really present. I'd like to see a little bit more, but you know, for us, it's really got to be all about the numbers. So
it's very important for us, and it's increasing in importance. And we're seeing kind of it becoming mandatory across the board as well, and more here in North America.
Same with us.
By what quarter do you expect to see what I'm calling more investor confidence and appetite in the investment for market for startups? Maybe thinking in terms of, you know, less friction, more deal volume, more deal size. So you can tell me it's already here. You can tell me it's what quarter, end of the year, quarter, next year, quarter. Give me a quarter.
Sometime next year.
Q1 2024. How's that?
I think for venture debt, 2023 is going to be a good year, and I think for VC 2024 will start to look better.
All right, there's consensus, 100% consensus on 2024 for VC next year. We didn't have time. Last question, as we're at time. Name one trend that will have. This is an easy rapid fire. One trend that will have the biggest impact on the fintech industry in the next 3 to 5 years. No pressure.
Open banking. If it ever happens.
Fair.
Go back to embedded finance for me.
Open banking.
2 on open banking. All right. Well, again, if it ever comes, well, maybe I should extend it to 3 to 10 years, and then we'll finally get it in there. That's our panel. I really want to thank everyone for your time. It was a really insightful discussion. I hope the audience also enjoyed it very well as well. I'll throw it back to Craig if he's around to just get the last words and sort of wrap up.